Welcome viewers to this panel discussion focusing on ESG trends and the investability of mining companies. This forms part of our suite of video sessions for the one-to-one mining investment EMEA online event for autumn 2020.
Yeah, again, comes down to materiality. What is material to the different business models?
Mining companies talking about the SDGs is a huge win for them.
The principal factor that I would be looking at is a do no harm factor.
I'm pleased to be joined by a panel of investment professionals with a breadth of experience across the natural resources sector and a deep understanding of the evolving ESG landscape. Introducing the participants, it's my pleasure to welcome Tal Lomnitzer, who's portfolio manager at Janus Henderson, Annie Markova, who's a board member at SilverCrest Metals and Golden Star Resources and has a long career investing in mining companies previously, Joe Mares, who's portfolio manager of the ESG Emissions Impact Fund at Trium Capital, and Jamie Strauss, CEO of the Digbee. And Carole Cable is going to be anchoring this discussion. Carole is a partner at Brunswick Group. And with that, Carole, I'll hand over to your capable hands to take us through. Thank you very much.
Thanks very much, Adam. And a warm welcome to our panel. I'd like to start off just for a couple of minutes, just setting the scene on our ESG conversation that we're about to have today. Because investors obviously are continuing to drive the ESG agenda. So we're lucky enough to have plenty of them on this panel to hear directly from them what they have to say. I guess I'd like to really point out that this isn't a fad. This isn't something that was just, that's new, that was just concocted in the last few years, and is something that, will come and will go. Today we have more than half of global asset owners are implementing or evaluating ESG considerations for their investment strategy. I'd like to throw a couple of statistics at you because I think they're quite important just to illustrate the point. When the UN-backed PRI launched in 2006, 63 companies or investment companies with $6.5 trillion of assets under management signed a commitment to incorporate ESG issues into their investment decisions. Today, that number of signatories has grown to more than 3,000 companies, which represents 100 trillion in assets under management. All that in just 14 years. And in fact, we probably can go back earlier than 2006 to the response of the Exxon Valdez oil spill in Alaska in 1989, which led to the creation of the Coalition of Environmentally Responsible Economies, or CERAs as we know it. And CERAs, as you probably do know, brings together investors, business leaders, and public interest groups to speed the adoption of sustainable business practices and the transition to a low carbon economy. And that was 31 years ago. This is not a fad. Brunswick did an investor survey over 2020, the results of which will be published in the coming weeks. But I just want to highlight three things that came out of that survey, which I think are really important, and no doubt the panel will pick up on them over the course of the next 45 minutes or so. One is that what we heard from investors was they want to engage. They want to engage with companies to encourage a more ambitious approach to ESG. There is a desire to partner with companies that are doing the right thing and help them improve by encouraging a more ambitious approach to target setting and to transparent reporting. The second thing is investors don't expect perfection, but they do demand commitment and progress. There's a willingness to work with companies if they can demonstrate intent and progress. And the third thing is investors are willing to draw the line if companies do not act on their concerns. Investors are increasingly willing to vote against companies that are not responsive enough on ESG issues. And those related to governance are often the key driver of shareholder activism. And the last point about the drawing the line is that investors have told us that exclusion is seen as a last resort to active engagement. So three things: they want to engage, they don't expect perfection, and they're willing to vote with their feet. So with that, let's turn to the investors and hear what they have to say. Tal, can I turn to you first? companies that fail to demonstrate progress on ESG are going to be limiting their access to capital. And you as a capital provider are looking at evaluating companies for your portfolio through an ESG lens. Can you just talk us through how you do that, and what is your approach, and how do you determine if a company is investable?
Sure. Thanks for the question, and thanks to 121 for organizing this and including me in this very auspicious panel. It's a topic that we consider to be of great importance, and it's good to be able to help in the conversation, spread the word. So from the perspective of the Janus Henderson Global Natural Resources team, this is a factor that we consider to be both a quality identifier for companies and a risk mitigant as we go through our investment process. So what you find for us, at least, is that ESG, sustainability, however you want to describe it, is embedded throughout our investment process. It starts at the beginning, where we screen a universe of close to 10,000 companies across energy, mining, and agriculture for sustainability themes. And we also exclude a number of companies based on certain avoidance criteria where they don't meet thresholds, or where they sit really towards the very low end of the performance scale on various metrics. Once we've sort of done that sifting, we've identified a group of companies we think are worthy of further investigation. We deep dive. We do this sort of classical investment stuff, but it's overlaid with a number of ESG factors. We've got a sort of in-house sheet that we use that has about 35 factors spanning E, S, and G, all fed in by Bloomberg. 10 years ago, it wasn't possible to fill the sheet with all the factors. 5 years ago, we were filling 50 to 70% of the sheet. Now you can pretty much fill most of that sheet with data. So there's been a real journey over the last 10 years of a lack of data towards now, I'd say, sufficient data out there, but perhaps now the issue is that data is very variable, it's unstandardized, and it's in a large range of sources, which makes it hard to get your hands around very easily. But that's an issue I guess we might come back to a bit further down the line. Coming back to the investment process, once we've identified all these criteria and really mitigated a lot of the risk that can stem from climate change issues, water security, energy efficiency, safety, social issues, and all the other issues, including governance, and are comfortable with all that, we will generally make an investment. We run a portfolio of around 70 stocks, and that's where the final element of bringing ESG into our process kicks in. And that's the measuring ESG outcomes, making sure that companies are walking the talk, and if they're not, engaging with them to hopefully find out what the issues are that are stopping them from performing and what they're going to do about it. As you mentioned, if that engagement fails, for us, the ultimate sanction is selling the company out of the portfolio and moving on to other opportunities. So I think the point that you brought out, that companies that either ignore this or don't perform are likely to face a higher cost of capital. In practice, that's going to come from the demand and supply for the shares themselves and the required return that equity investors are going to impose. And I think we'll start to see that, and indeed are seeing that coming through on the debt side as well, where we're increasingly hearing about various facilities that are tied to ESG performance, and the better you do, the lower your cost of debt. So I think that cost of capital issue is a real one, and that's probably where the rubber really meets the road for a lot of companies when it comes to ESG.
Thanks, Tal. That's that's super important. You're absolutely right. I mean, today we're talking about equities, but you're right. The debt capital markets are increasingly playing a role in this, with more and more banks announcing that they are changing their lending policies with respect to lending to either specific companies or specific commodities within those companies. Joe, can I turn to you now just to hear, because you run a new ESG emissions impact fund. So I'd like to hear your approach to, what goes in and what doesn't go into that fund. And you're on mute, Joe.
Yeah, I mean, we do some of the similar things that Tal mentioned, but just to answer directly, the way we think about it is we start by looking at end markets. And our view is, I mean, we talk about exclusions. We don't invest in coal virtually. I don't care if the management says they're doing everything possible enough great governance. Our view is it's very hard to see how that can have an environmental footprint, which is attractive even with CCS, so we don't do it. We're interested in end markets where we think there's going to be growth in a green economy. I mean, all the names better than anyone in this panel, but whether it's copper, nickel, cobalt, et cetera, we're interested in those growing end markets. We do similar screens probably that Tal does. We're interested in basically the outliers, so we're interested in clearly in the best, and then we're interested in the fastest improvement. And that's kind of how we think about how to find stocks from an ESG perspective in our fund.
So is that taking a top-down approach, and then once you've either excluded or screened, then you look from the bottom-up approach?
Yes, is the short answer. The other thing is we tend to focus on companies on the smaller end of the scale. We don't look at the largest mining companies in the world because our view is those are probably the most analyzed companies, and certainly they're the ones in any ESG improvement is going to be immediately recognized, and they're probably the most they probably get more credit. Well, they'll immediately get credit for whatever they do. So we, like most investing, our view is to try to find things that are not in the price. And so generally, as you go down the market cap curve, you find more of those opportunities. So that's the other thing that's slightly different about what we're doing.
Okay. We're going to come back to that small versus large, because I think, and the impact on valuation, because I think that's an important point we're going to bring out in through this conversation. But Annie, can I turn to you, because you're a former investor and now you're a non-executive director on 2 mining company boards, so you have the luxury of being able to see both sides of that ESG coin. And I just wondered, if just picking up really on Joe's point about the sort of the big versus small, do you see that ESG is, I don't know, is picked up or is incorporated maybe easier or maybe in a more transparent way in the larger companies because they have the resources in which to do so, versus smaller companies? And is that reflected in the valuation? Is there such a thing as, a fully valued mining company based on ESG and a company that is not yet fully valued?
Yes, thank you for the question. I'd like to step back and perhaps offer a little bit more all-inclusive answer to this question. We need to recognize that the mining industry is very complex and highly regulated industry. There are so many environmental permits that each operator needs to operate within, which are very much focused on the environmental side, the energy, the water, and all the other components to that. Also, the ability of working with unions, with employees to have the social license to operate includes the communities. So I'd like to say that the mining world has been very much on the forefront of having this balance amongst all stakeholders in order to be successful in what they do. I think investors, but however, the industry has not been very good at communicating all of the impacts that they've had, positive or negative. I mean, we hear the negatives through the headlines if there's disaster that happens, but we don't hear about all the good net positive benefits that mining companies are bringing forward to remote communities, to third world countries. I mean, every project, when you have to see it as an investor, and the life of the project brings capital investments in infrastructure, building hospitals, bringing teachers to remote communities, having such a derivative, second and third derivative of that job creation that they offer, alternatives to cutting trees, polluting waters, and all their other things that are actually impacting climate change right now in the world. So overall, I think we need to kind of separate are mining companies good ESG providers? Yes, they are. We have not told our stories well in a context that investors need to see. Now, have the improvements been sufficient? Do we need to do more? Absolutely. I think this is where the extra disclosure now that investors are looking for, properly assessing how now the business models are going to function and operate in this ever-changing environment, where we see a lot of pressures for disclosures on the environmental side or the climate change side, on the social engagement side. And I think it's a process. It's not an overnight success. It's a journey. So we all understand now where the UN SDGs are and where we need to get by 2030 or 2050 in terms of decarbonization. How quickly can we react to that? Because there is a true cost to the companies needing to invest today in the solutions vis-a-vis the returns they need to provide. So this needs to be taken into the holistic assessment of value. And I think this is where investors could help the companies segregate how do they add extra points for investments in more water circulation or capturing more of their emissions or replantation to make them net carbon neutral. So I think this is a team effort of disclosure. Where the large companies are, I think they are now a little bit ahead of where the juniors are, because they've had the resources, they've been engaged with the investors, they now understand what investors are looking for, and it takes the whole organization to actually be able to design those ESG frameworks and be able to implement them and report on them. So I'd say they're a little bit ahead in their disclosures, and that's why we see their data in Bloomberg and being able to use it for selection purposes. When I was a portfolio manager a couple of years ago, my portfolio was NA. When I had conversations with my the chief investment officer every quarter, he's like, well, how do you rank? How do you manage this ESG issue? Because the companies that I invested in, they had no disclosure. So to help that, actually, I've started working with a Canadian developer. So we just launched a cloud-based ESG reporting solution that is a tool that even the smaller companies could organize themselves and help them better illustrate and help investors understand what they do. Because in most cases, the juniors are doing more than they're reporting on. And I think this is this disconnect of, are they doing the right things? Are they moving in the right directions? Do they have the right strategies? A lot of times, because of the size of the companies, it's unaffordable for them to have the big teams to come and the consultants to come and do it. So this is why providing those affordable solutions to them to be able to automate that and get efficiencies and have the conversation now with investors on what's important. And it, again, comes down to materiality. What is material to the different business models? And those also very different. We have to differentiate around that. So it is a journey. I really would like to encourage all the juniors to start reporting. It doesn't matter where you are. Start with your top 5 most material issues that will impact your ability to deliver on the promises you've made to your capital providers. And we'll certainly could grow as the companies grow from there.
Thank you. Thank you very much, Annie. That's really insightful, because you're absolutely right. There has to be a partnership between the investors and the companies to find a way forward along this pathway, because the investors themselves are getting pressure from their shareholders on their decision-making processes, and how how they're getting the information that they need to inform their decisions. And if they're a fund that is invested in junior mining companies and the data is just not there, then how do you justify that? So there's a lot there. Jamie, junior mining companies and data that Annie makes the point that the juniors are doing a lot. They're doing a lot on the ground. That's where the boots are, and that's where they have to engage with their communities. And prepare environmental impact assessments and social impact assessments and feasibility studies, et cetera, et cetera. How do you fit into the equation with Digbee?
Okay, thanks, Carole, and thanks for One-to-One having me and this great panel. So I think I'm going to come to that question, but I think that what we mustn't ignore is actually the potential positive impact that this could have, ESG could have, not just on what we're all looking at here with regards to the world and environment and the social impact, but actually on this industry as a whole. I mean, this industry is trading on 6.5 times free cash flow, and it's at the bottom of the S&P E&S rankings. Perhaps the two are not completely coincidental. And so if we can, as it comes back to a number of what my previous panelists have said, improve the perception of what this industry does do and has done for many years, and improve our reporting capability across the entire industry, then moving us from, and I know Tao also covers agris, moving us to 11.5 times free cash flow, which is I think where the agri food chemicals are, that we haven't even done one bit of change on the output of this industry other than just improving our perception and hopefully improving things on the ground as a result of the things we do. So that is the win-win scenario for the mining industry as a whole: junior, small cap, big cap, medium cap, everybody. So how does no, go on Joe.
No, just to follow on from that. I mean, we have this discussion, and not to preempt the next question, but I always think mining companies talking about the SDGs is a huge win for them. Yeah. And because mining is going to, if you actually read through the SDGs, I mean, you need mining to achieve basically all of them, as best I could tell. So, I would certainly agree, our view that mining is part of the long-term solution to the broader, societal problems than the problem. So I certainly agree. The more you turn the discussion to that, but I would completely agree with Anna, and that's very exciting that you have that app and everything else. And I send it to me. I'll blast it to all of our companies tomorrow. But my view is that the disclosure is you can't complain about the perception if you don't provide the data. So I think that we got to start with disclosure, and that's an easy win, and it certainly makes Tal and my job a lot easier, because it's really tough for us to hold stocks where we can't get the disclosure. I mean, it just basically is almost impossible at this stage for us to do that.
So just to finish that, I mean, everybody has said, you can't have a transition to a sustainable future unless you have mining. So this all comes into the same bucket, and I think that's a really huge opportunity. But the core is, and I think Carole, you highlighted, these mining companies need to be able to demonstrate what they are doing on the ground. They need to be able to demonstrate that the actions they have taken, not just in the last year or so, but in the last 5 years or 10 years, have done that. And they need to be able to do it in terms of a journey in order to make sure that the investors are able to easily identify the proof of that and the journey in order to go from A to B. So what Digbee has done over the course of this year, as a result of being encouraged by a number of the senior capital providers in the mining industry, is effectively put together a right-sized set of frameworks, pre-PFS, post-PFS, and will be producing, which will launch in late this year, early next year, which will be industry endorsed. We're going to announce our partners in the course of the next month, but it includes private equity, institutional fund managers, hopefully an insurance company as well, which we haven't mentioned, and I think that's a really important point on where this is going, as well as a producing company, as well as being relating it to a lot of the juniors, and to make sure that we encourage them to get on board at a cost-effective basis to allow them to not only mitigate their own risk, but also to demonstrate the capability of what they're doing in a transparent, disclosable way, which is board approved. And that will then allow, and obviously to have a natural scoring structure that goes along with that. So that's basically what it is. And we hope to launch, I think it's going to be very early next year.
That's great, great to hear. And there is a, you know, as you've all been saying, there seems to be a plethora of data, not necessarily across all sizes, but there's a lot of stuff out there. There's a lot of different rating agencies. There's a lot of different standard setters. Now there's a lot of different data sources, which I think probably had to happen in the early days as we were, you know, as the world was finding its feet through ESG. But what has ended up happening is there's kind of an alphabet soup of all these different agencies, standard settings, data providers, research providers, etc. And how do you think that companies can, you know, figure out their way through all of that? Like, what is meaningful and what isn't? I'm going to go back to you, Jamie, and then I'll go back to the rest of the panel, because I think I'd like to explore it through two lenses. One is investors. You know, how do you get through all of this? What do you think is important? Do you prefer, you know, from a reporting point of view, do you prefer SASB over TSFD or any of the other ones? Do you prefer MSCI over Sustainalytics or Bloomberg on data and research and rankings? Jamie, can you start us off with trying to address that melee of letters?
Yeah, I think it's a great question, and I think a lot of people are trying to discuss this and how we're going to get through this, and not just in mining, I think generally in the world of ESG. So first of all, I think there's a huge amount of inefficiency at the investor level because everybody's sending out questionnaires, and there's complete fatigue from that, from the companies and from the investors themselves. So, and when we're all trying to get to the same point here, to a large extent, some people have more in-depth needs than others. So if we can cover the broad part of it, then in a standardized structure, right size, then that obviously helps the investors. But equally, and I have a lot of first-hand experiences, I know others do, like Annie here, with regards to being on the board of a couple of companies. These smaller companies are caught in headlights. They Google ESG reporting and they're completely lost as to what they got to do. So they've got to be able to pick up something which is, again, right-sized and appropriate for them. And to answer directly to your question, with all of these different, I think there are over 40 different standards which you could apply to mining. They're not all mining related, but they could apply to mining. And that is a problem. So what we have done is we've taken through Satala, which is our consultant on the ESG, who are well known, I think, ex-Anglo-American bunch. And through Satala, they have basically mapped the most common areas of as many of those common initiatives as possible, and brought them into the right-sized approach, whether it's pre-PFS, post-PFS, and ultimately producing, so that we have a practical solution to effectively address investors, insurers, and other stakeholders' needs for the junior miner who can actually be out of that dazzled headlight situation and be able to then demonstrate its capabilities. So I hope that answers the question from that point of view.
And Annie, can we flick to you before we turn to our investors and hear, you know, what you think from a smaller mining company's point of view?
I think that Jamie's right. We need to help the industry, and this is what the Onion platform is geared towards, really the junior resource companies, simplify the reporting needs and to make it usable, not only for the management teams, but for boards as well as investors. So we need to work with the priorities for individual companies as well. I can come back to this materiality assessment. Because of the limited resources companies have, especially on the junior and mid-tier size, it is very important to understand what could change the risk factors and what could change investors' investability parameters around the key issues, because it will be a little bit different company to company. Yes, perhaps some of the data can be standardized, but it also needs to be in terms of priorities. Where does the company need to put extra effort into designing the management systems that go with recognizing and reporting around single issues? So how do they manage it? And how do they report on it? How is the governance working around those issues? For example, water stewardship. I mean, yeah, the investors want to know, are you in an area where water shortage is a problem? Yes or no, right? So if you're yes, so how are you going to deal with this? How are you going to make your business viable for the long term, over the life of the mine? So those are the things that really look at the longer term risks and opportunities. And I think this is where most juniors need help. It's not just reporting. After you report, right now it is, let's report, but then how do you tell the story? What is important? How do you use this data to improve? And I think this is where the conversations need to migrate towards, not just give me the raw data. Yeah, we have to measure it to understand what's happening and what the trends are. And Joe said he wants to invest in companies that have improvement of trends. So yeah, let's define that, but let's standardize it a little bit, because it is impossible. I'm telling you, it's impossible for the companies to be able to satisfy every single questionnaire gets thrown at them, not just by investors, but rating agencies, proxy advisors. I mean, there's a lot. So
there's a lot. Yeah,
I think that the regulators are catching on now, and there are conversations that are happening at very high levels for standardization. We've already seen the World Economic Forum making an effort to standardize those disclosures. We're seeing even the IFRS is starting to think about how do we standardize and integrate those disclosures within financial reporting. So within a couple of years, I think we'll have more solutions. But between now and then, my advice to companies has always been focus on what's really important to your business and make sure you capture the data, you know your data, you can tell your story, and you can get engaged with all your stakeholders and explain through transparent ways who you are and how you're doing your business. And that only can improve the risk profile of the company.
That's good advice, communication, but you need to have the proof points underneath. You need to have the data to support what you're saying. Otherwise, it's just looking like greenwashing. And Tal, can I turn to you and then I'll come to Joe? Standardization of, do you see that going forward of reporting? Is that a trend?
Definitely. As Jane pointed out, there are over 40 standards out there, and it's this sort of alphabet soup is impossible to deal with, both for the companies reporting and for us. And it's an issue that's very live. I think it is getting better. Only a month or so ago, I believe there was a working group formed between the GRI. I'm going to go alphabet soup on you now. The CDP, the IRC, the SASB, and so on, to generate a comprehensive corporate reporting structure that mutually recognizes each other and is comprehensive. And that would be an amazing step forward. For what it's worth, I think SASB is a very good starting point. And I think I wouldn't be fearful of picking one to go with, because I think they will all ultimately converge. And having done the work on one gets you 80% of the way there, probably on all of them. So my guidance to a junior company looking to set things up would be pick one. As I say, I think SASB is very workable. It's got sort of 11 key materiality issues identified for mining companies. It gives very strong guidance on how to go about measuring various things. Some of them won't be relevant, some of them will. But to just get from that starting point, it will immediately put a junior company into the top quartile of reporting, even for just a few basic components. So I think it's going to get better. But the other thing to be aware of is there's big change coming in Europe. At the end of this year, we'll get the first European taxonomy, the first couple of things published on that. That's very much part of the European Union's push towards decarbonization of the whole energy system and broader economies. And there's a huge amount of money that backs that. I can't remember exact numbers, but we're talking about, sort of $1 trillion of investment that's going to be needed over time. It's going to need to find its way somewhere, and they're trying to guide it towards places where they can be assured that not only are the companies doing good, as a lot of these companies are, but that they're not doing bad. And that's going to be quite an important step forward. That's going to herald the next step, which is the formalization of the NFRD, the non-financial reporting disclosures. That's going to apply to big companies. So a junior is not necessarily going to get caught in that, but we're going to have to start being aware, as are all these companies, about the whole supply chain. So if you're a company that supplies copper concentrate to a smelter that provides copper cathode or end copper to a wire manufacturer, and that wire manufacturer sells it to a wind farm, and they want to be assured all the way through that chain that things have been done appropriately, that's going to drag juniors into this reporting matrix, even if they're not legally obliged to do it. So talking to the LME, they're putting contracts out there. They're talking about sort of socially responsible contracts for copper or aluminium. All of this is coming to pass, I think, in the next year or so. So it's coming a lot quicker than people think. I think if you'd ask the average person how long this is going to take, they'd tell you 2 or 3 years. But I think that the incentive is going to be faster than that. And it's going to be a very good reason. It's going to be a stick. It's going to be legislation in Europe. There's also going to be a carrot, which is this large sum of money that's going to be invested. And as they said in Jerry Maguire, show me the money. That's going to pull a lot of reporting together, I think.
Yeah, and it's absolutely right. It's driven by investors, right from the retail consumer all the way up to the institutional investors, because at the end of the day, people, consumers and people in general want to know where their materials come from. They care that it's responsibly sourced. So you're spot on about that supply chain. Joe, do you want to add some sage advice
I would say this. I think, unfortunately, I hate to be honest, but it's going to get more confusing before it gets less confusing. To all the points that Tal said, it's actually, if you go through EU Green Taxonomy, which they haven't even really fully done yet for mining, that's going to probably make it more difficult for both investors and mining companies than easier in the short term. And I would completely agree with Tal's view that, you're trying to get to the top of the mountain. It doesn't really matter which path you get to. I mean, you're going to have to, you might as well just start. And I think that would be what I would say to every junior is, don't let the alphabet soup stop you. SASB's fine. If everyone starts with SASB, we would gladly take it. From our perspective, we have to, we have end clients who, unfortunately, for better or for worse, are each wedded to a specific process. So we kind of have to do everything, which makes our life difficult, but don't let the cost of that stop you from doing something. That'd be my advice. And I would also say, just as a personal pet peeve, I mean, I know it's extremely difficult in mining, and mining is poorly understood by investors, and mining does a lot of stuff that people don't understand, but actually in sustainability, it's going to be easier for mining than some other sectors. Having looked at some of these other sectors, actually, if you go through some of the chemical sectors, I mean, good luck trying to basically sort that out with all the, intermediates going in and out of these plants and everything else. So I think, and actually I would argue the one thing that mining has as part of its, as I mentioned earlier, as part of its SDGs is, mining is bringing very definable social outcomes in a lot of the areas that it's operating in, which a lot of other sectors are really going to struggle to answer that question. So I think, we have to basically focus on the positive rather than complaining, because trust me, I think, mining has got a good story to tell as part of this as well.
If we come together and it all comes together as one, it's a very easy story and journey to improve our perception. And that to me is what a great opportunity is. Because it's pretty binary. The environment's pretty easy in the, I say it's easy, it's not so easy if you're PHP or something, but it's pretty binary as to what we need to do. And the social, obviously, you just got to do as much as you possibly can and do it in a structured and beneficial way for all those relevant stakeholders.
The other thing I would say, we touched upon it earlier, but in terms of large versus small, I would personally say the large companies are probably overvalued or overrated by the ESG rating companies because of the fact that they have very extensive investor relations and public relations and can publish 200-page sustainability reports. But actually, the task of a junior is actually, while it's a larger percentage of cost, generally the operations are there's less operations and it's a lot simpler in terms of actually trying to figure out what is going on and actually track what's happening, just because the scale of the operation is more manageable. So I would argue it's from a junior miner perspective, it just, the problem is clearly cost, and also on a lot of these metrics, unfortunately, as anyone who is a user of these metrics realizes, they were not designed for small growing companies, right? Because there's a lot of metrics which are based off units of sales and market cap and all sorts of things, which kind of, there's a big difference if you're in a business which is rapidly growing, whereas if you're in a business which is basically running at a flatline basis or shrinking. And clearly also in what we look at, it's a lot easier to show reductions in emissions when you have flat output relative to when your output is rapidly growing. And it's also a lot easier to implement improvements when you have operations that are already generating a lot of free cash flow, and you can work with your existing infrastructure to sort of show improvement, rather than when you're actually physically going in. It's just like, obviously, as everyone knows, when you're stripping away the overburden, it doesn't look so good on the numbers, but then once you get into the ore, it looks a lot better. It's the same thing in a lot of these environmental things. In the beginning, you're naturally, as a smaller company, not going to screen as well on a lot of these things. And I think part of what people have to appreciate, both as investors and as companies, is the right way to look at something is basically on a life cycle basis, on per unit, or over the mine life or over the company life. It's not just to pull data off the top. And I think one of the challenges across the entire investing world is that increasingly, unfortunately, there's less and less people like Tal and myself who are making the decisions, and more people who are making decisions just based on data feeds. So it's incumbent upon the managements to understand that, and to really try to seek out investors who are actually taking active choices and are able to basically evaluate things on that basis, because they're your natural investor base. It's going to be very hard as you release metrics to screen well to a computer, unfortunately, as a junior miner. That's just the reality.
Yeah, and that's an important one. We need another session to talk about AI, I think, on that regard. But it's great advice to smaller mining companies that look out for your natural investor base, but also to figure out a way of telling the story, as you said, over the life of mine. So it's a compelling story, and it's not just sort of looking at data that may or may not be scary in year one or year two, and then maybe that's the way you might attract generalist investors, because I think a lot of these companies are looking to widen their shareholder register away from just dedicated natural resource funds to a generalist fund. I'm conscious of time here, and I want to go around to each one of you, if I may, because you've all talked about materiality, and that's super important. And I just wonder if we can just go around to each one of you, and if you could just give us a view on, what do you think are the main material issues to the mining sector on the E, on the S, and on the G. Tal, can I start with you?
Yeah. So what I would say, the principal factor that I would be looking at is a do no harm factor. So the principal factors I want to see every company reporting on is, what are their greenhouse gas emissions, what's their water consumption, and what's their safety record. Those are three very easy, objectively measurable quantitative factors which can be published, which I know that a company that's drilling holes in the ground in Ecuador, a lot of these measures are going to be sort of nonsensical when it comes to looking at them. But if they can tell me what their emissions are and how much water they use and exactly how many near miss incidents they've had, that immediately tells me that they have a culture internally, and that word culture is incredibly important to me. Mm-hmm. They have a culture internally that they care about this sort of stuff, and they're measuring it. But the first time I met a junior miner that told me that they are offsetting the emissions from their air travel was last week. You know, I'm sure lots of companies are doing it. Maybe they are, maybe they aren't, but no one's telling me about that. And immediately that puts that company on just a different level. It's not a particularly expensive thing to do, but as a signal that this company cares about what it's doing and the impact it has, that's very important. So, you know, a lot of these factors are hard to measure. You know, a lot of the companies that they report to the Sustainalytics box tick, and they look at policies, and companies that shouldn't score well do, and companies that should score well don't. What I was going to say is it goes well beyond just quantitative measurement. Culture is very important. There are a few ways of getting cultural information, and getting down to site is one of those. And so that holistic picture, you know, it's the culture that binds environmental performance with societal impact, with governance into company financials. And it's these factors that all support ultimately what we care about, which drives share prices. It's profitability and sort of steady profitability. And so they're getting rid of those idiosyncratic risks. You know, culture is the key to all of that.
Annie, over to you.
Well, to echo what Tal said, really investors are looking at profitable companies, but not at the expense of the planet or the people. How do you balance it all? How do you communicate it? And especially for the junior and the mid-tier companies, I would say the governance is high up there. So I would actually reverse it. I said the G, the S, and the E in terms of prioritization, because the likelihood is if you have the proper governance structures, you probably are taking care of everything else around you, and that captures the culture of the company, the values, which needs to be translated into your policies and execution. And then it's like a complete circle of this is who we are, this is what we do, this is how we do it. There's no particular issue for me that I could highlight, because they're all important. They're all interconnected. And in balancing,
I'm going to turn my video off because it really makes everything go unstable.
It is crucial. So balancing it all is all crucial. And again, prioritization is key. So I'll leave it at that.
Thank you. Jamie, over to you.
So I think that's a good question, but I think in a way I fully agree with the culture and the approach which Annie and Tal have come at, but I think we need to slightly move on. Sure, G is slightly different from E and S, but we need to kind of get away from the silo structure of this and make it more integrated, and therefore to allow people to encourage, embrace this process, which will ultimately lead to a change of culture. This is not a bureaucracy. It's easy to be classified as a bureaucracy, that I totally accept, but actually it's a means to mitigate risk in your business and at the same time improve conditions on the ground and in the boardroom. And I think if we get away from the siloed approach to it and have it as an integrated basis, this will lead to a really dynamic impact throughout the industry, which hopefully will ultimately lead to what we were talking about earlier, about an industry benefiting the world, the globe, the industry, the companies themselves, and also ultimately investors with a higher rating. Ivan Glassenberg said at the FT conference the other day that he's leaving the industry and looking forward to getting into a new industry which has a higher rating. I think Ivan's got the timing wrong on this one. I think this is about to really achieve a completely new era if we can all come together.
Well, let's. What a great sentiment that is. Joe, can you top that one?
Well, probably not, but I would just say, look, you know, the analogy I'd use is the human body, right? I mean, you know, you need a circulatory system and a respiratory system and, you know, a muscular system and all this stuff. And the same, you're going to need ESG, and you're also going to need profitability in companies. So you're going to need, I mean, to sort of say this is more important than this is, I mean, clearly any of them in their absence is destructive to the entire system. I mean, but to make it very short, I mean, everybody, for better or for worse, is going to look at your emissions profile, and whether it's relevant to your business, because as Tal says, you're just literally doing drill holes in Ecuador, and so it's irrelevant, but they're still going to basically be forced to look at it. I mean, I would argue almost in some of these companies, filing an income statement is also irrelevant, and almost as a junior minor too. But I mean, it's still, everybody does that. So it's one of those things where it's kind of like you just do it, and it probably doesn't mean anything, but you kind of have to do it. And the other thing everybody looks at is going to be board composition, and everybody's going to have a different way to try to evaluate that. But that's something that's going to get looked at closely, because again, if you don't have a lot of physical assets, to Tal's point, people are going to look for signs that they're going to look at the people, and they're going to try to see, are these people who I should be investing money with, where they're going to look out for what's best, for me in my absence. And I think that board composition is a great way to start. So I would just leave those two comments.
Okay, that's hugely helpful. Well, everybody, I think we've run out of time, but what an engaging conversation, and what a fabulous panel you've been. I mean, I think we've heard a lot of great advice for the smaller end mining companies, the juniors and the mid caps. We've also heard some great insights from investors, as well as from Annie and Jamie. I would think that the integration is the way that companies really need to think about ESG is as integrating it into your business strategy, and critical is telling that story to bring, I think, as our panel said, bringing trust back into the industry from the top down as well as from the bottom up. With that, I'd like to thank you all very much for being such an engaging panel, and I wish you a great rest of the day.
Thank you.
Thank you very much.